Good morning. Welcome to the Techno Fundamental Report for August 31st. Boy, August was difficult. Tough month. Fiduciary. We are fiduciaries. As registered investment advisors, we have an obligation to our clients to place all their interests above everything else. One of the things we have to really pay a lot of attention to is that when we go to buy a stock, we realize that we're buying a business. So we want to have a solid balance sheet. We want to see earnings going in the right direction, not always positive, but in the right direction. We want to see, revenues going in the right direction. So remember, when you're buying a stock, you're buying a piece of the business. This is not like a CD or a bond where you're getting interest. So we have to be very responsible. Now, one thing to realize is that as a retail investor, meaning a small investor, you have tremendous edge over the institutional investor. Now, remember, most of the volume on these exchanges is institutional activity. So large volumes, we have small volumes. Now, what does that mean? It means that you don't have liquidity risk. Think of it this way. You're like a ski boat. This is like a big ship in the ocean. It's very difficult to turn a large ship. Whereas when you're dealing in small volumes, you can move quickly. You have a lot of flexibility. It's the greatest edge that you have. Now, as we get down the list here, we do mention liquidity here as a major advantage. They have low liquidity. They have trouble. In other words, they have liquidity risk. So when you're managing billions, if not trillions of dollars, it really becomes a difficult process. Did want to talk a minute about the banks. We're getting some downgrades by S&P. We also got downgrades or warnings of downgrades by Fitch. These are your grades up here. Now, even the U.S. government bond has been downgraded. Now, what's the problem here and the reason for these downgrades is the mortgage market, which these banks have invested quite a bit of their portfolios in mortgages, and unfortunately they bought when yields were low, and now yields are high and they're underwater on the mortgages, and that's the purpose of these downgrades, is just bring to the fact that mortgages are hitting, at 7.23. That's a new high for the mortgage rate for the 30-year mortgage, and that's causing damage to their portfolios. Now, there is good news. Last week we were pretty dealing with the major August correction, and it was really because interest rates were continuing to climb. Well, this is the power index. Now, we've been using this index for decades, and we have found it to be quite useful. In other words, we're taking the rate of change on the 5-year Treasury note yield over 125 days. So you can see here that we have now crossed back below zero, which means that interest rates have really started to flatten out. This is incredibly good news. Advanced decline line, we did see a little bit of improvement there. You can see here we came down all the month of August. I mean, just down, down, down. Now we've pretty much put in a double bottom here, kind of almost a bigger drop. Then we rallied. So the advanced decline is looking better. So far, so good. New highs minus new lows on the NASDAQ. That too has turned back up after this August correction. Hopefully this correction is over. So we can only tell you what we see. I mean, we're not going to project anything. We're not going to look too much at history, but history is really all we have. Now, this is three things to consider here. One, you've got the trend meter. This is the NASDAQ. You can see we got down into the yellow, which is neutral. And now we've moved back into the green. We've also broken out. We made that low here, and we've now stabilized, broke out of that base, and we're back above that 50-day moving average. And on Tuesday, we had higher volume that we've had in a while. So things on the NASDAQ look positive. Now on the mid caps, we'll kind of move quickly here. Mid caps, came down, based, breaking out above. Trend meter still in the yellow, but we are seeing improvement there. On the New York Stock Exchange, all the stocks on the New York Stock Exchange, we've gone from yellow, we're moving to the green. We've got a breakout above that base right there, and it's breaking out above the 50-day moving average, which is a very good sign. So we're seeing several indexes here that are improving. This is the most important one for risk-on type thinking. This is the small cap index. Again, you can see it basing down here at the 200-day moving average, and then now it's gotten back above both the 21-day and the 50-day, looking better. S&P 500, same story, came down, made the low, formed a base. We're breaking out above the base. So we're starting to see some improvement here. Now, the primary trend has been up. We said this last week that we're still in a up cycle here. The primary trend is primarily the 200-day moving average. And so you can see in both cases with the NASDAQ and the S&P, the trend is up. So we're still in a positive trend. Did want to kind of reflect again on the Copic Curve. It is, we'll get an update next week, but so far so good. It basically, the purpose of the Copic Curve is to say, okay, we've gone long enough into this cycle here. It's time for that to end, and we're going to start a new up cycle. Difficult market, easier market. So it looks like the market put a low in around the 3,500 area, and that's what the Copic Curve is really trying to tell you. Now, other good news here is the aggression index has improved dramatically here. Not only did it break out back above the moving average, but it's made a new high here in the most recent time period. So we're starting to see outperformance of the growth stocks versus consumer staples, which are very defensive. This is a very important indicator, and it is giving us a positive signal. Now, on our three economic indicators, again, just take a look at your interest rates. They are rolling over. Looks better. The price of oil has somewhat stabilized above the 200-day moving average. However, the 200-day moving average is in a downtrend, and the price of oil is trying to rally here. Financial stocks, we're looking better there. Again, we've got somewhat of a flattish 200-day, but we held it, and we're moved back above it. So all in all, what I'm saying is that as fiduciaries, we have a responsibility to look at a lot of factors, a lot of indicators, and we've got to also realize that diversification is important. Now realize over-diversification can do more damage than what we call focus investing. We think, like Warren Buffett, that you need to be a know-something investor, meaning that you need to know everything you can know about the companies you're investing in. So if you start investing in 30, 40, 50 stocks, that becomes somewhat impossible to do. So if you think about, 10 stocks, you say, if you make a mistake and you get into a bad business situation and you have a 10% stop loss, well, 10% of a 10% position is 1%. So you would risk 1% of your portfolio with a focused approach. So if you have any questions, please give me a call. Thank you very much.